We have the very, very special John Studzinski joining us as always right here in Davos at ET Now. Thank you very much, John, for being with us. We're talking at a time when the world economy and the world at large is particularly going through some kind of a global gloom of sorts. Let me begin by the IMF. They've slashed the global growth forecast from 3.6 to 3.4% for this year and also for next year. What, according to you, are some of the pressure points that the world is seeing? And are you somebody who also believes that global growth is going to be far tapered than previously believed?
I think the growth globally, particularly in emerging markets, we've already seen that where their debt is denominated in dollars. They're having to deal with the slowdown in those economies, the fact that they have not met expectations, Brazil being an extraordinary example. But having said that, I would question whether the readjustment in the global growth targets is actually enough. I do think global growth will slow down, and I think it'll probably slow down more than 0.2%. Clearly the United States will still come in with a growth of about 2%, 2.25%. Europe probably 1.5%.
That's right.
But the overall global growth is only going to be buoyed by whatever growth we find in the second largest economy, which we know is China.
That's right. I'm going to speak about China in just a bit, but because you touched upon the US, you're somebody who believes that the growth in the US is going to be lower. And coming from the fact that there have been 8 years of accommodative policy, isn't that strange and doesn't that concern you?
Well, I think growth in the United States, even at 2% of the biggest economy in the world, is still substantial growth. If you look at some of the more attractive sectors in the States, healthcare, business services, professional services, plus you've had a lot of growth of jobs driven by the shale sector. Now remember, the shale sector is undergoing a lot of restructuring at the moment because a number of these shale opportunities have gone belly up. So a lot of those jobs were created through the shale innovation. Professor Obama, that's a real faux pas. Right. President Obama did not approve the pipeline. And had he approved the pipeline, you might have had a continuation of some of those jobs.
Fair point indeed. Let's turn focus and talk about China. I mean, that seems to be the big focus point here in Davos and also globally. People are very worried about what will happen in China because there are two camps. One that believes China is going through a transition period, and the other that believes that China is in an absolute mess. Which side of the two camps are you on? Because economy is slowing down and debt is swelling up, and China is exporting a lot of the trouble to other markets, particularly India, emerging markets.
I think China is a very complicated situation, and it doesn't lend itself to either economic, fiscal, or media sound bites. First of all, let's remember the leadership there is an extraordinarily skilled and well-trained, well-groomed leadership. President Xi is about as good as you can find anywhere on the planet in terms of someone who's had an extraordinary experience. People are often mixing up the need for a readjustment of the economy and the growth with the volatility of the stock market. And they are really two different things. The ability to regulate the stock market and the readjustment of those prices downward is something they've got to get right. And there's no question they're learning that. But the economy and the soft landing is something which the government is well aware of and they are managing. Remember also, China's not one economy. There's probably now about 6 or 7 economies, depending on their economic region and what sustains that region.
You know, what concerns us about China is that whatever happens in China is having repercussions around the world, and particularly for emerging markets. We've seen huge outflow of foreign funds. That's point number one. And point number two about China is that the whole commodity crash that China has, in some sense, triggered, isn't that a point of concern that the world is pondering over? Is that something that bothers you?
Well, remember, China has been responsible for 1/3 of global growth for the last 7 years. So we've had the benefit, the world has had the benefit of China's growth. So maybe the world needs to embrace the fact that China's growth is slowing down. They've announced today 6.9% growth.
That's right.
We obviously think growth next year will be somewhere between 5 and 6%. This year, meaning 2016.
That's right.
And their consumption of commodities is obviously slowing down, or in some cases has entirely stopped.
That's right.
And remember one other thing, China only consumes 10% of the world's oil. Many people think it's 30 or 40%.
Right.
It's not. America and Europe consume 40% of the world's oil. They're much more important, and those economies are much stronger.
That's right.
So if anyone's going to get oil prices up, it's going to be demand from Europe and North America and not from China.
So I'm going to speak to you about oil because I know that's another point of concern. Many people believe, I mean, especially emerging markets like India that depend on a lot on oil imports. Our fiscal is going to be in a great position and all of that, but also a prolonged period of very low oil prices is going to have repercussions for global economy. I mean, we've seen BP and Shell and everybody else slash jobs. We've seen crude prices test levels of under 30. Where do you see crude settle? I mean, and when do oil prices begin to inch up?
Well, I know you'd like me to put on my large crystal ball here and talk about it, but I think when one looks at a lot of fundamentals in terms of the amount of production available, the fact that no one is setting constraints on their production, there's no question that prices can remain between minimum $20 and $30 a barrel, certainly for the next 2 to 2.5, 3 years.
Just before I move on to India, and I know you were a big bet, you have big bets on India, I want to ask you a question on the US Federal Reserve. They began the whole process of increasing rates. There has been one rate hike. But given the global turmoil and given the economic reality that the world is witnessing, do you believe Janet Yellen can continue to hike rates even though she may do it at a very deliberate, at a very, a very sustained, slow pace?
I think she said that she's going to increase rates several times this year. I think she'll probably increase rates no more than once. A lot of real estate outside of certain cities in America is declining. So there is a concern about disinflation or deflation, and that is one thing that she's been very wary of given her knowledge of what's happened in Japan historically.
Let me just switch focus to India because IMF and World Bank believe that India is a bright spot in an otherwise gloomy world, and we in India seem to celebrate that. But someone who's got their bets in India, and you're a huge investor in India, invested in about 13 companies there, how do you see the Indian economy unfold? Are you happy with the pace of reforms? Because many people believe it's considerably slowed down.
Well, I think you need to remember that what Mr. Prime Minister Modi is dealing with is much more complex. And we were talking about China being complex. India is very complex. And clearly what he did in Gujarat was a bit of a jewel box. He's now got to deal with the federal structure and he's got to deal with the states. And the way President Obama hasn't been able to control the 50 states, Prime Minister Modi is seeing the same thing. But we're positive about India. We're now going into our second decade as Blackstone investing in India, and we're clearly the largest foreign investor of real estate in India. We're the biggest owner of office parks in India, and we're very positive about the country overall. But I think this has to be a little more measured about the pace of reform. And I think, if anything, if you were to criticize the government, you'd say the government has to manage expectations more aggressively. And I think perhaps when Modi came in, he was perhaps very enthusiastic and perhaps too enthusiastic and didn't manage expectations.
And do you believe that's the price they're paying for, the fact that people are getting disillusioned because they had such heightened expectations? They thought he has a magic wand that can fix every trouble that exists in Indian economy.
I think they looked at Gujarat and thought he was a very good reformer. But at the same time, I think he's got to deal with the political reality of India, which has got many different constituencies.
Does Indian politics trouble someone like you? The fact that we have seen a legislative logjam on game-changing reforms, for instance, the tax reform that we're trying to usher in, that's the GST. Does the political standoff in India bother investors like yourselves?
I think we take a long-term view about India. As I said, we've been there for 10 years. We see ourselves being there for the long term. Political standoffs are what they are, but it is the world's largest democracy. I realize you still have hundreds of millions of illiterate people, but you also have a very strong emerging middle class, and that middle class has become much more rigorous in terms of consumption.
And which are the sectors in India that still excite you?
Well, real estate, I think, remains at the top of the list. And we've recently just reinvested in a couple of areas of technology. And there are obviously areas of interest in power generation as well.
All right, let me just turn focus from India and take two quick last questions, and this is on the PE and the VC deal. A lot of experts around the world believe that the next sticking crisis will be in the PE and VC deals, given the leverage and the series of follow-up funding that has happened in the last 8 odd years. Is that something that PE and VC deals, yes. Is that something that's bothering you?
No, you're actually the first person who's ever raised that. PE, I think if you look at leverage right now in certain spaces, there is a lot of leverage in the oil shale space, as we talked about earlier, in the United States. And some of those companies are having to restructure their credits. I don't really think this is something, there's really no concern at all or focus at all on the private equity space. One of the things that you'll note is since 2008, the amount of leverage that's gone into private equity deals is substantially less than what you saw in the period of 2000 to 2008.
So at least that's one less area to be worried about in this world today. One last question. In 2008, 2009, we did see a lot of distressed deals happen around the world. Is the time again ripe and right for those kind of deals to happen in the world in 2016?
And when you say distressed, how do you define distress?
Because companies that were in trouble or sectors that were in trouble, we did see a lot of deals happen in there.
I think the major area of consolidation right now, driven by balance sheet fragility, is going to be certainly in the oil space in North America.
John Studzinski, it's a pleasure talking to you. That's John Studzinski from Blackstone in conversation here with ET Now in Davos.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.